Welcome back, everyone, to the 7th International R3.0 Conference. I hope everybody had a great break. I hope folks enjoyed the mindful movement at the beginning of the break. Remember that happens after each of our sessions, and it starts out our breaks. And now we're back for the session on finance and growth. And so this session features Tjeerd Krumpelman from ABN AMRO, Natasha Lamb from Arjuna Capital, John Fullerton from the Capital Institute, and Jason Hickel from the University of London. So we're very excited about this session. It coincides with our launch of the Sustainable Finance Blueprint. And so you can see right there, that is the final report of the Sustainable Finance Blueprint. It brings to a close a 12-month development process involving a working group of about 40 members that includes some of those in this session. So as you can see, we include a set of recommendations that are led up to by an introduction to the field of sustainable finance, critiques of its shortcoming, and then a set of enabling factors that set the foundation, a set of activation factors that can be applied in the existing system, and then a set of transformation factors for transforming to a new finance system. So we encourage all of you to go to our website to check out that Sustainable Finance Blueprint. The link is listed here on the slide, but also will be included in the chat by our facilitation team member, Cleophia. So we will be focusing on the question of finance and growth, and we're going to start out with Tjeerd Krumpelman from ABN AMRO. And Tjeerd has been a speaker at the R3.0 conference for several years. And we have been really privileged to watch the progress of the ABN AMRO reporting in particular about their work on sustainability in the context of the bank. So Tjeerd will kick things off by presenting on the journey that ABN AMRO has been on, a journey that in many ways dates back to Tjeerd's attending an early R3.0 conference when he had first started in his role with ABN AMRO around the sustainability reporting function. And so we've really been on a joint journey, and we in particular are looking forward to seeing where ABN AMRO is heading next. Having been in conversation about future directions and the importance of reporting for fueling the transition to sustainable finance. So Tjeerd, over to you.
Thanks very much, Bill, for this great and warm introduction. It's good to be here again. And as Bill said, one of my first conferences was the Berlin conference, actually. It seems like ages ago and much different time frame than now, but really good to be here. And I'm going to try and share with you where we are at ABN AMRO on our impact journey. And what do we actually know about our true impact that we have as a bank. Now, the first few slides I'll go through them rather quickly, but it's just to kind of set the scene as to where we are. And this is our purpose and strategy, banking for better for generations to come and accelerating the sustainability shift. And it's good to emphasize that this is not our sustainability strategy. This is our group strategy. So this is the only strategy that we have. And this is what we've been working on since, for many years, but it's been reviewed and refreshed 2 years ago, and we're currently refreshing it again. And our goal is to really embed sustainability into the heart of the company. Within sustainability, we have chosen 3 focus areas where we feel we have most impact. That's in combating climate change, in stimulating the circular economy, and in creating social impact. So these are more focus areas where we feel our impact is larger given our activities. And just to give you a sense of the bank, I'm not sure everybody knows ABN AMRO that well. We are with around 18,000 employees. We make around 2 billion in profits, which is on the right. And our biggest activity is in the middle here. That's client loans, which relates to mortgages and corporate loans. That is around 2/3 of our balance sheet. So we're relatively a medium-sized Dutch bank with a strong emphasis on mortgages. Now, the concept of sustainability and long-term value creation has always for us been related to the reporting that we do. That's also part of my job, to develop the integrated report and to support that production, but also to feed senior management with the concept of integrated thinking. And this slide actually summarizes how we approach this. So we feel that both integrated thinking and integrated reporting supports better decision making. And if you're able to to make better decisions, then you're also able to create more long-term value. That is the concept behind it. Now, in terms of reporting, we see a wide variety of developments. So there's been financial reporting, there were sustainability reports, there still are. There are several combined reports. Some would call them integrated reports already. There's now the development of impact reporting, and there's also kind of a tendency for continuous reporting. This is all really exciting stuff. At least for me, it is, because it's part of my day-to-day activity. But the concept behind these reports should really be built around integrated thinking, combining different capitals, different stakeholders, and assessing the impact that your value creation or your activities or your value chain has on them. Now, being in the financial sector, it's also good to know that we are not alone in this space. We are not here to just develop our own strategy and to push that forward. We are also bound and committed to various more global activities. The Paris Accord, there's a Dutch version of that Paris Accord as well, or a Dutch translation. There is the EU Sustainable Finance Action Plan, the Principles for Responsible Banking, and so on and so forth. Now, there's also various tools that you can use to report or measure and report your impacts, and hopefully steer on them as well. So we are one of the founding partners of PCAF, that is set out to develop a methodology to account for carbon. We're also an active member of the Science Based Targets Initiative, and we use the PACTA and 2 Degree Investing Initiative tooling as well. And we've started a journey with the Impact Institute a few years ago, and I'll go into that in more detail. And obviously, there's the TCFD recommendations that are relevant to a lot of companies, but specifically within the financial sector. Now, our impact journey. So what have we really done on impact so far? And it started around 7 years ago as part of our normal and regular reporting cycle. That's kind of the journey that you see here. So we used to have a real live sustainability report, and then we grew into a combined or an integrated report, and now we have a separate integrated review, and we've also developed the concept of impact reporting. And these reports, for those that enjoy this, are all available obviously on our website. But the journey of impact and measuring that impact became or started off quite small. We started with in 2012, 2013 with really small pilot studies for the bank on very specific business units. And these were mainly done internally. So not all these studies were disclosed, but some of them or summary of those reports were disclosed and are available for you to read. But we kind of learned how to cope with this concept of impact. Then, as part of our 2018 reporting, we went all out in a full impact report. And this was actually the first bank, we were the first bank to publish this. We got some awards, which is always nice. It's always nice to get this type of recognition. And last year, we developed this concept further into the Impact Report 2019. And we actually embedded these impacts into our integrated report. And I'll show you that in a minute. And there's a 3-step approach that I really enjoy, and everybody within the bank, and I talk to a lot of other companies on this topic as well. It's really simple. You start by measuring, and then you want to report on it. And ultimately, you want to steer on this concept of value creation and impact. This is the value creation model that we used, and this is not something that you can read on the slide or on the screen now, but what I wanted to share here is that we end up in our value creation model all the way to the right with our impacts. And gray impacts are negative impacts, and the green impacts are the positive impacts that we feel we have created, in this case in 2019. Now, there are still improvements to be made. These are some of the improvements that we made from 2018 to 2019. And for the 2020 cycle, we feel that we need more alignment, and there's some small improvements, but we're also looking for some more consistency. So we want to make the comparison year on year, and we want to have a higher level of assurance. This is the day-to-day work that we're processing as we speak. This is what it looked like last year, and for next year it will be kind of similar. Now, there's all kinds of frameworks out there, and we follow and we study most of them. We work together with various partners in the field, but for now, our reports are based on the open standards of integrated reporting and of the Impact Institute. I'm not going to go into the details of that, but the nice thing about these standards is that they are all open standards. Any stakeholder can read them online and can see what kind of choices that we have made. Now then, going to the topic of impact, what is actually our impact? And this is a summary slide, so there's much more detail behind it, but this is a summary slide that I also use within the bank a lot, just to give a sense on the different capitals and the different stakeholders. So you see the capitals on the left, you see the stakeholders on top, and per stakeholder and per capital, we have assessed, we have given an overview of the impact. And again, I can talk about this for hours. Ralph and Bill know this, but that's not the goal of today. Happy to elaborate on it offline or further or at any other meeting. But for now, this is just to give you an overview on how we have incorporated this concept of impact into our business. We've addressed the SDGs and integrated them as well. We feel 8, 12, and 13 are most relevant from an impact perspective. So we've done some deep dives on these SDGs, but we've actually assessed all 17 to see where our biggest impacts are. And from a banking perspective, it's always good to restate that our biggest impact is downstream, right? It's in our operation. It's not in our own operations, but it's actually downstream with our clients. What are they doing with the loans and the investments that we provide for them? And this is where you see the negative impact on natural capital as well. And this is all part of the impact studies. Now, this is already my final slide. I think it's also fair to say that from a matter of perspective, where are we at the moment? I think we're quite well on the way on the measuring. We're getting to grips on that. We need some more detailed data sometimes, but we are working really hard to get it. I think the reporting can still be improved, but is relatively advanced. What is actually the next goal is to use all this information to steer. And this is a challenge. I'm not, and that's why I'd like to mention it as well. This is not something that we do on a daily basis. We don't use all this information for steering yet. And I know that the previous speakers and the blueprints are quite often related to thresholds and allocations, and the steering is also part of that. So we need to steer into the right direction. We need to link it to science-based targets. We need to link it to clear objectives for the bank. That is the process that we are currently in, and we will be in that process for a while. So that's it as a kickoff from me. Handing it back to Bill, I think, to introduce one of our next speakers.
Great, thank you, Tjeerd. And it's really wonderful to see the progress of ABN AMRO, in particular, now getting into the realm of thresholds and allocations with your tie-in with science-based targets. So just as Tjeerd has presented to our Transformation Journey program meetings, so too has Natasha Lamb, our next speaker from Arjuna Capital. Those of you in the United States in particular may be familiar with Natasha from her many appearances on Bloomberg and other very visible outlets. Based on Arjuna and Natasha's work, particularly on shareholder activism as it pertains to climate and equity issues, which is going to be the focus of her presentation today. We were lucky enough to get a version of this in presentation at a Transformation Journey program at John Hancock in Boston last year. And so there's been developments since then, and we look forward to hearing more about that from Natasha. And I'll also mention to folks, thanks for starting to pose questions. We've already got some great questions coming in on the chat. So please do continue to share those questions and gear them towards specific speakers as you can. So we're just waiting for a moment here for Natasha's slides to come up, and they are all set. So over to you, Natasha.
Hi, good morning. Thank you so much for the introduction. Happy to be here with everyone. Happy to be able to attend this virtually. My name is Natasha Lamb. I'm a managing partner at Arjuna Capital, which is a boutique wealth management firm and asset manager. We have fossil fuel-free investments. We integrate ESG. We engage as active owners, and we invest in solutions. And today I'm going to talk about engaging as active owners in the companies that are in our clients' portfolios. And I'm going to talk about incrementalism and transformation and where we are in that journey. So as a planet, we're facing an existential crisis. And I don't believe it's simply an environmental crisis, the crisis of climate change. I actually believe that's a symptom of an unsustainable paradigm. And we really need to think about what are the root causes that got us here. And I think a lot of that is the imbalance of power that we have structurally and who makes the decisions. So today I'm going to talk about both. I'm going to talk about this environmental crisis, and I'm going to talk about the imbalance of power and how not to step off the cliff, how to scale that cliff instead and create an inclusive, regenerative economy. And I know John Fullerton is going to be an important part of that coming up as well. So I have long believed that sunlight is the best disinfectant, right? That all change starts with transparency, that you need to open the door to the closet, look inside, take a look at the problem, and then that leads to accountability, and that leads to action. And maybe a simpler way to put this for anybody who's familiar with the 12-step program, you have to admit that you have a problem in order to solve that problem. So what we need to do is we need to start by looking at the problem, which is our current business paradigm. and ask ourselves, when we look at a company, is the business model degenerative? Is it sustainable? Or is it regenerative? And when we're thinking about progress, is progress incremental? Is it structural? And is it transformational? And these are really important questions as we think about addressing this existential crisis that we are all facing. So I'm going to use ExxonMobil as a case study in how incrementalism and structural transformation can be a challenge. And maybe incrementalism is a little bit easier and structural transformation is a bit more difficult. So in 2014, we asked ExxonMobil, and we had, right now we're a fossil fuel free investor, but we have clients with legacy shares of ExxonMobil. So as active investors, we went to ExxonMobil in 2013, going into 14, and asked the company basically to admit that it had a problem. And we asked them for their first report on climate change and carbon asset risk. And that is, if we're going to keep temperatures below a 2-degree rise, then what assets of ExxonMobil, their fossil fuel reserves, will be at risk, which would be stranded, unburnable, devalued in that paradigm. And in about face for ExxonMobil, we got them to disclose, right? We got them to write their first climate change report, and it was a big deal, and everybody was excited about it. And when the climate report hit, everybody was equally disappointed, because instead of it really being a practice in disclosure, which, it was, I guess, it was more so a practice in denial, in terms of saying, the world's poor needs fossil fuels and they need cheap fossil fuels. And there's no way that global governments are going to limit our ability to service this straw man of the world's poor. And so this 2-degree scenario is not going to come to pass, and our reserves are safe, and we're at no economic risk. And so we took this as for what it was, which was an exercise in denial, and said, okay, this is a company that is not managing a risk, and a real existential one in particular for this company, because the business model is ultimately unsustainable. And so we went back to the company the next year and we said, okay, instead of investing in these high cost, high carbon projects, why don't you instead reallocate some of that capital back to shareholders, who can then invest through dividends and share buybacks, and those investors can go invest in more sustainable business models. And of course, ExxonMobil did not like this for a number of reasons and fought it at the SEC. And ultimately, we were able to get it to the ballot of the company. But it wasn't just resistance coming from ExxonMobil. We actually found the larger resistance after sort of battling to get it to the ballot. The real resistance was with large institutional investors that would only vote for issues of disclosure and not of action. And I remember being invited to a invitation-only event with oil company executives and some of the largest pension fund managers in the world in New York. And they did a breakup where the investors went in one room and the executives went into another. And I asked, would people support this? Is this of interest? And what I heard back after 3 or 4 of these conversations was, well, we only vote in favor of disclosure, not of action, which was very discouraging. So back to the drawing table, we went back in 2017, 2018, and went back to more of a disclosure ask and said, how can you transition your business plan to make it more sustainable? And that could include returning capital. It could include following the example of your European peers, investing in renewable energy. And it got an okay vote the first year. And the second year, it actually hit up against the SEC again, because while we were asking for these incremental steps, some of them may be transformational, other large investors were asking for better reporting. So if that report we got in 2014 was 1.0, they were asking for 2.0 or 3.0. And there was more reporting that came after. The problem is that it really didn't get us anywhere better than where we started. But it was enough reporting that the SEC said, well, no, they don't need to write a transition plan because they're already disclosing all this information. So we went back again and we decided, okay, we're going to address this from a governance level where investors have more latitude and more rights. And we asked the company to put together a board committee on climate change, because what we knew is they met once a year to talk about climate change, and the CEO and the chairman were the same person, and there wasn't progress being made. And, we got that to the ballot the first year. Again, even though it was governance, hit up against that. It's an action ask with the large institutional investors, didn't get a huge vote. And then this past year, in in a real unprecedented move of the SEC, who's feeling a lot of pressure, and there's a big fight right now for shareholder rights, they said that it was micromanaging. We couldn't ask for a climate change board committee. All those similar board committees had, happened in the past. And so that was sort of unprecedented. So also in 2019, Exxon found itself in court because the Attorney General of New York brought a suit against them for misleading information they put in that report that they wrote in 2014 and information they had shared with their investors. And I was called as the first witness in that case, which of course made ExxonMobil love me even more than they did already. So, here is almost a very frustrating case study, and asking for, sort of this incremental change and then structural change, and facing so much resistance. And so, here we are. Here we are in the public markets as active owners, trying our best to make some transformational change and hitting up against these barriers. So how do you change an unsustainable, advance my slide. So how do you change an unsustainable system that is run by the same group of people that created that system? So in this case, that's white men, and apologies to my white male colleagues on the call today. But, it's sort of this exercise in insanity, right? How do you solve the problem the same way, using the same methods that created the problem? And so it's really a question of who's making these decisions? Why is there so much resistance to change? And what are the incentives, right? So if you have an oil company where the incentives are growth for growth's sake, how do you shift those incentives? If oil executives are paid for growth, how then do you incent profitability over growth? Like, we ask them to return capital and sort of shrink profitably, but that's not in the oil company executives' best interest, because that's not how their incentives are aligned. And then the other question is it a zero-sum game, right? We're living on this finite planet. It's one system, and we play this game constantly of I win, you lose. And the oil companies will say, or at least I know Exxon would say, well, if all of this comes to pass, it's not going to affect us because we're so efficient that we will be the last man standing. And, do any of us want to be on a planet where, everything's fallen apart so much that now Exxon's the last man standing in this unsustainable paradigm? It's really in our self-interest to create win-wins, in our enlightened self-interest, wins for companies, for employees, for the environment, for investors, where you're aligning financial goals. And so that's what we always try to do in our work, is to make the business case for change and why you can create a different paradigm that isn't a zero-sum game. So I'd like to shift to another case study, which is how do you change decision making? And one of the big questions that we had as a firm when we started looking at the diversity of the tech sector was, where are the women? What, these very homogenous organizations that were having all these cultural problems. And we wanted to engage on diversity and really, how do you change not just the leadership, but how do you change the whole organization? And what we knew from the research was that if you have more diversity and more diverse teams, the decision making is better. There's actually more innovation. There's radical innovation, which for the tech companies was job one. So we decided to engage on this issue of diversity through the lens of pay equity. And not just for women, we also addressed for minorities, for people of color, pay equity to create more diverse corporations. And when we first went to the companies, we made the business case. We said, okay, you want to be able to attract and retain top talent. You want to draw from 100% of the talent pool, and you want to move women and people of color into leadership positions. How do you do that? And what we argued was, from a disclosure standpoint, we want to make sure that people are being paid fairly for the work that they're doing, right? And that that the folks that are in the highest paid positions are not just white men, which was mostly the case. So when we began, really no companies were releasing any data on pay equity in the United States. And when we first started talking to the companies, the sort of where we were able to get the first incremental step was for them to do an analysis, a statistical analysis, and look at what, a man versus a woman, a person of color versus somebody white, what they were paid versus each other if they had same seniority, same geography, kind of same role. And they did these statistical analyses and they started disclosing the outcomes. And what we found, which was a huge step, and we got 22 companies to do this, from Wall Street to Silicon Valley to the large retailers like Amazon and Starbucks. And what we found was they could solve for this problem in a pay cycle or two, right? They could shrink any gaps that they had by giving out raises, and they gave out millions of dollars in raises and addressed this issue. And it had a wonderful effect, not just on those industries, sort of this ripple effect, but on other industries as well. But it didn't get to the root cause of who's making the decision. So we went back and we said, okay, yes, we want people to be paid fairly for the jobs that they're doing today, but we want more diversity in who's holding these high-paying jobs. And so we went back to the JP Morgans and the Citigroups and the MasterCards and the Apples, et cetera. And we said, we want to see what people are paid on a median basis, on an average basis. And if you look, for instance, at the gender pay gap in the United States, women are paid 18 cents less than their male peers, or than males who are also working full time. And that's how it's measured. And that's how it's measured globally. That's the definition of pay equity. So we said, okay, you need to reveal on average what people are making. And that was a much tougher conversation because it hit up against structural issues and structural change. And we pressed, because if JP Morgan's diversity is all tellers and admins, that's not really what we're looking for as investors, looking for transformation. And so because these numbers were so unflattering, the median or average numbers, it's been very difficult to get them from companies. But so far, we've pressed Citigroup, we've pressed Starbucks, we've pressed MasterCard successfully to disclose these numbers. And what we found with Citigroup, who was the first who sort of bravely stepped out of the group and showed that they had a 29-cent gap for women and a 7-cent gap for minorities. We're like, yes, that's honest. That's an honest accounting. And when they came back this past year, with their second year of data, they had shrunk the gender pay gap 2 cents and they had shrunk the racial pay gap 1 cent. And even though that might not seem satisfactory, that's real structural change that's going to happen over time. And that's where you align the goals of the company, the goals of the employees, the goals of the investors. And that's a win-win-win, which is what we're looking for when it comes to this kind of structural change. Thank you.
Great. Thank you very much. That was great, Natasha. And in particular, I appreciated the exercise in denial from ExxonMobil and the exercise in insanity from your fellow investors who will support disclosure but not action. So thank you very much. I know that we've already got some great questions coming in. I would remind folks to please tell us if you want the question to be geared towards a specific speaker. That's very helpful, but please continue with the questions coming in over the chat. And now, as Natasha mentioned, focusing on regeneration in her presentation, we take it over to John Fullerton of the Capital Institute, who we've been working with closer and closer as time has passed. This is a recap or a return performance. John spoke as a keynote at our 2015 conference, and that planted the seeds around an approach to focusing on the bioregion. So we're glad to have John back here for speaking with us about regenerative finance this year. John, over to you.
Thank you, Bill, and thank you, Bill and Ralph, for the invitation back. It's always nice to be invited back to a party, not just get one invitation and that's it. For those of you who don't know me and my work, I spent 20 years on Wall Street, deep in the belly of the beast, and about 10 years ago, after a long search and journey, set up Capital Institute to explore what a sustainable economy and sustainable financial system might actually look like, and had the freedom to kind of look out into the future. It's something that I've done all of my career. I tended to be good or early at seeing what's coming, and less good at executing what's present. So I'm delighted to follow the previous two speakers who are up to their eyeballs in executing the present, and obviously both of their work is vitally important and a critical piece of this journey toward a regenerative economy that I've become very passionate about. I've released a sort of a second large paper called Finance for a Regenerative World, and it's built on the ideas that were in my first paper. Just seeing if I can get this to go. There we go. About regenerative capitalism. And today I'm just going to talk about the fourth section, Act 4, which is about public policy recommendations to actually support the transition to a regenerative financial system in service of a regenerative economy. One of my heroes and teachers, Dana Meadows, was keen on saying that vision is the most important part of the policy process. And she also pointed out, and I totally agree with this, it's the piece that policymakers rarely have the luxury to even imagine, because they're given a set of constraints that is the present system. So much policy formation is really responding to problems as opposed to using policy to drive us toward a future we actually want. And so I've taken the luxury of actually trying to explore what that future we really want is and what it looks like, and not constrain myself with the practical challenges of how we actually get there, knowing there's great people like Natasha around who will figure out how to make it happen with more patience than Job. So so this is admittedly a futuristic, some will say idealistic view, but I don't think we'll get where we need to go unless we have the courage to stake out what that future looks like. So the beginning point is to get clear about what economics needs to say and needs to be, and what finance needs to be in service of. And so again, there's lots, I've written on that, and a lot of other people are exploring this idea. So again, that's the context or the foundation for what I'm going to talk about today. And for those of you who are familiar with my work, you know that I've tried to reduce to 8 principles how living systems work and how they apply to a human economy. These aren't the quote right principles, they're just one white man's best effort to reduce to 8 ideas what is impossible to reduce to a finite number of ideas. Just like a painter who paints a landscape at sunset, you put 10 painters next to each other painting a landscape, they're all going to look different, but it's the same landscape. So just view this as a high level estimate of what regenerative systems look like in the context of economies. Now, I've in the paper, I've put the current sustainable finance agenda on a map that Bill Reed shared in the context of the built environment, and I use it in the context of the journey toward a regenerative financial system. And you can see there's no bubble for the good bank like ABN AMRO, very different than the big banks we have here in the United States. But the Global Alliance for Banking on Values is very much, I would say, at the cutting edge of this march, and banks like ABN AMRO, whose vision and strategy is a sustainability strategy, is very essential toward that march. But you will see on there active engaged ESG being to the right of passive ESG, and for reasons that Natasha, I think, made clear. And of course, impact investing. And frankly, everything off on the right in the green is the future. It doesn't really exist yet, but that's where I believe we need to head. But with respect to the 10 policy ideas, this is what I came up with as the most important things we need to do if we're serious about a regenerative economy and a financial system in service to it. The first is we must massively constrain speculation. You know, the timing of this SoftBank purchase of call options on a few tech stocks like Tesla and Apple couldn't have been better for this point. It is literal insanity when you have a firm of the scale of SoftBank spending billions of dollars on option premium on individual stocks, which then translates into massive volatility in the markets that you're seeing play out as I'm speaking. This is literal insanity. And there's lots of tools we can use to curtail speculation, taxes being high on my list. For example, the financial transaction tax, and we could talk for hours about other ways to curtail speculation. But I'm talking about curtailing speculation on a scale that would reduce trading volumes by more than 50% in all major financial markets, particularly the ones that are most speculative, such as stock markets. The second is to reduce leverage. This chart that you're looking at comes out of living system science from real data, and it shows the importance of balancing efficiency and resiliency. And the reason we use leverage in financial situations is it creates greater efficiency on capital. In other words, higher return on capital. But we learned in the financial crisis, and we're learning again and again and again, that a resilient financial system cannot be over leveraged or it gets too brittle. So we need to move the entire financial system. We need to de-lever the entire financial system. And that's made even more the case when there's inherently increased volatility due to all of the systemic uncertainties that we're facing. So we should move radically toward a reduced leverage in the global financial markets. The combination of these first two policies, and again, there's lots of ways we can do that, like start by stop subsidizing leverage the way we do today by making interest deductible. We should be subsidizing the use of equity and penalizing the use of debt. Now, that's a complicated conversation for another day, but the combination of these first two policies alone, done properly, would shrink the financial sector in proportion to the real economy by well over 50%. I'll just say that one more time. The combination of these two policies, if implemented correctly, would shrink the financial sector relative to the real economy by a massive order of magnitude. And I believe that's the only pathway we really have if we're to implement and transition to a regenerative economy. We need finance to do what we need finance to do, but we also needed to stop doing things that increase the inherent volatility and complexity and risk in the system. The third policy is to regulate for fractal structure. And again, to repeat something earlier, everything I'm saying is rooted in applying these 8 regenerative economy principles toward the financial systems. These aren't like one guy's idea on what we should do. This is just following the principles and seeing where they lead. Well, living systems are living systems because they're really good at circulating energy, and they follow a fractal structure. Everything from the arteries in your body all the way out to the cosmic level, and every living thing in between. So what that says about a financial system is that we need some big banks, we need some big financial institutions like our big arteries. They need to be in service of the health of the whole. But critically, we need the medium size and the small size, massive diversity of financial institutions to move circulation of capital into the real economy where it's needed. And of course, the natural tendency of the financial sector is to get bigger and bigger. And so we need to, again, restructure the financial system, which can be done with capital requirements, taxes, all kinds of policies that would force, rather than us decide how we're going to break up JP Morgan, just make it uneconomic for there to be a firm as large and powerful as JP Morgan, and it will break itself up. And that's what I would recommend. At the same time, incentivizing the creation of smaller specialized institutions to help circulate capital where it's actually needed. The fourth issue is to prioritize business formation and small business rather than what we do currently, which is essentially state subsidies for massive businesses. The entire lobbying industry in the United States is largely working in the interests of big business. And what we actually need is to move the diversity of businesses into the small business formation side and again, have policies that support that. That's, again, not my personal preference for small business. That's not some quaint old idea. Wouldn't it be nice to have stores on Main Street? That's actually the way living systems work. There's massive diversity, always reinventing itself. And so we need to encourage entrepreneurship, innovation, and adoption. That doesn't happen in big institutions that get big by being resistant to change, Exxon being an interesting case in point. The next issue is to obviously reform our tax system. There's a guy named Peugeot who figured this out a long time ago. We basically need to tax what we don't want and not tax what we do want. But what we do, and everything I'm saying, by the way, I should have said this at the beginning, is very much a US perspective, and yet I think everyone can adjust and adapt that toward their own domestic situation. But taxing things that are unhealthy, like speculation, like leverage, like carbon, like windfall profits, like dynastic wealth, like consumption, the way they do in Europe with the VAT tax, and like land, and particularly land speculation. The sixth one is we need and when I wrote this, we weren't in the middle of the COVID crisis. We're now testing sovereign money on a scale that I never imagined. But modern monetary theory is something I've written about in the paper. Stephanie Kelton has just put out a new book on it. But the idea that we can actually use federal money to finance what we need is to me a critical piece in the puzzle here. We can't simply say, well, governments are broke, we can't possibly do this. I know I'm running out of time. Point 7 and 8 are essentially transforming fiscal policy. This transcends everything from spending and infrastructure to subsidies and research. Again, just one comment on research. We tend to be, again, following Natasha's point, we tend to be reactive in funding searches for problems, solutions to problems, and that the problems are really symptoms of the underlying systemic failure. So yes, we want to do research for cancer treatment, but more importantly, we want to invest in research for health, holistic health, and understanding how our immune systems work. And if the COVID crisis has taught us anything, it's how important our immune systems are, and we need to learn how to invest in those. Ninth one, redesign philanthropy. I put a quote up here that it blew my mind, but of course it shouldn't have. Years ago when I wrote an article about philanthropy, it says the laws of accumulation will be left free, the laws of distribution free. Individualism will continue, but the millionaire, and this was Andrew Carnegie, so we'll have to insert billionaire, will be but a trustee for the poor, entrusted for a season with a great part of the increased wealth of the community, but administering it for the community far better than it could have done for itself. Now, if you can't think of any worse idea on how to structure our philanthropic sector, that quote pretty much sums it up. But honestly, that is very much the way philanthropy still works. So this, again, is a massive conversation for another day, but the inherent philosophy of philanthropy needs to change. The scale needs to go up by a factor of more than 10. We've created massive financial wealth at the expense of social capital and natural capital, and we need to recycle that wealth in alignment with the way living systems work. Again, this is not a political ideology. This is just following the principles of living system and what they tell us. We're severely out of balance, and balance is one of the principles. Balance of male and female, masculine and feminine, is also one that we're extremely out of balance, as Natasha mentioned earlier. The pace of moving that capital into the forms of capital we need needs to be massively accelerated. This 5% rule, where you only have to spend 5%, is insane. It should be at least 3 times that, in my opinion. We need to move, as I mentioned earlier, from reactive philanthropy on problem solving to systemic philanthropy. The incentives and constraints need to be changed. We should no longer get a tax deduction to put up one more building at Harvard University. We should have a more narrowed focus on what we actually need the capital to go into. And then, of course, there needs to be more accountability, since this is essentially the public good money. We need more involvement in the public in overseeing how this money is invested and how this money is spent. And finally, and this is probably my most radical thought, not that the others aren't pretty radical, and this will be a nice tee up for Jason. If there are limits to growth, as Dana Meadows pointed out in her famous Limits to Growth book 30, 40 odd years ago, that implies there must also be limits to investment, because investment, real investment, I'm not talking about financial speculation, I'm talking about real investment in the real economy, is a component of growth. That's a hard one. That says we actually need to make choices. We need to prioritize what we invest in and what we don't invest in. And that will require some form of oversight. The way a utility can't just put up a nuclear power plant, it actually has oversight in how it does that. As hard as it is to imagine, we as a society, the human race, given its scale, is going to need to figure out how to prioritize what investments get made and what investments don't get made in order to create room for the things we actually need to survive. So finally, I just will wrap it up with a final quote from Dana Meadows, just to reassert my claim for not having an implementation plan for all this, which is, she says, long ago, she stopped challenging herself or anyone else who puts forth a vision with the responsibility of laying out a plan for how to get there. A vision should be judged by its clarity of values, not by the clarity of its implementation plan. And so while the implementation plan is obviously key, the clarity of values that I'm trying to propose is the clarity that we need to align our economy with the principles of how living systems in the real world actually work, which happen to be remarkably aligned with our indigenous wisdom. And we need to figure out the implementation plan to get there if we're serious about the project of the human race. Thanks very much, and I'll turn it back to Bill.
Great, thank you, John. And we look forward to having our sustainable finance blueprint function in part as that implementation plan. We've often spoken with each other about that sort of synergistic connection between Capital Institute, where we're relying on your visioning work for our sustainable finance blueprint, and then we're adding implementation options to that. And this does lead directly into our final presentation from Jason Hickel. A reminder to folks to keep posing the great questions. We've got some wonderful ones coming in. And Jason is in some ways representing most clearly the notion of growth. And I'll put air quotes around that. Jason is a foremost thinker and a speaker and writer on the question of post-growth or degrowth. So we're looking forward to Jason sharing some of these thoughts with us today. We do include some of Jason's work in the Sustainable Finance Blueprint. So in particular in the transformation factors section of that report. So as soon as Jason's slides are ready to roll, we're going to be going over to him. You also might want to check out Jason's work on Twitter. He's very prolific and profound there. So over to you, Jason.
Thanks very much, Bill. Okay, so yeah, what I wanted to do with you in the next 10 minutes or so is to introduce you to this idea of degrowth, which I suppose some of you have probably heard about. It's an idea that's really kind of developed a strong consensus in ecological economics, and has strong backing from climatologists as well. There was a recent paper signed by 11,000 climate scientists, gosh, was it last year, I think, calling for the world's governments to abandon GDP growth as economic and political objective. So this explores that terrain a little bit. So I want to start with this image of the planetary boundaries framework, which I suspect some of you have probably seen. Probably the most important innovation in ecological science in the past couple of decades. It gives us a sense for where humanity is at with respect to key Earth system processes. Where you see yellow is basically where we have overshot safe thresholds in Earth system processes. Where you see red, we're basically in a zone of severe uncertainty and at risk of triggering irreversible tipping points. And so what this illustrates is the fact that it's not just climate change that is the crisis we face. That's of course one dimension of it, but it's also, you know, a collapse in biodiversity, you know, through mass species extinction, widespread deforestation, chemical loading due to industrial agriculture, and so on. Okay. Now, what I want to argue here is very briefly that this kind of polycrisis in ecology is being driven at a structural level by capitalism. Now, let me clarify what I mean by capitalism here. When people hear of capitalism, they tend to think, oh, that's a system that is based on markets and trade and businesses, which is true, but that's not in fact what distinguishes capitalism from other economic systems in history. Markets and trade and businesses long preceded capitalism by hundreds, if not thousands of years. Capitalism is only about 500 years old at most. And it's the first and only economic system in history that is structurally organized around perpetual expansion, right? So capital has to grow, you know, in aggregate at about 3% per year. This is where we get like our GDP growth metrics from, effectively, and that's an exponential function. I mean, it sounds like a sort of a small increment, but in fact it's exponential, and so it multiplies very, very quickly, beyond what human minds are actually capable of comprehending. We'll get to that in a second. But what does this look like, this trajectory look like when it comes to the ecological impacts of growth? Here is an indicator that we use in ecological economics called global material footprint. What this indicator does is it tallies up the total weight of all of the material stuff that the world's nations extract and produce and consume every year. And what we see here is the red line is 50 billion tons. What we see is that global material consumption blew past that safety threshold, which scientists define as a safety threshold, in the late 1990s, and it's been accelerating since then. Okay, and this is remarkable because there was this assumption in the 80s and 90s that resource use would decline as we decouple GDP from material footprints. In fact, we've seen that has not happened. On the contrary, the opposite has happened. Over the past few decades, there's been a rematerialization of the global economy as GDP has actually been growing as material footprint has been growing at a faster rate than GDP on a global scale. And this is despite a shift to the service economy. There's all sorts of reasons for that, why we see this refusal of any meaningful decoupling between these two. But all existing projections indicate that even under highly efficient scenarios, in the future, there will be no absolute decoupling of GDP from material footprint. So the more we grow the global economy, the more resources we use, the more pressure we place on planetary boundaries, not just climate change, but on all other dimensions as well. Okay. Now, crucially, I just want to, as a bit of an aside, mention that the language of the Anthropocene is actually incorrect. In fact, overshoot is due not to humans in general, but rather to overconsumption in rich countries specifically. What we can see here is material footprints per capita. The red line represents the sustainable threshold in per capita terms. We see that high income nations are the ones that are vastly overshooting the sustainable threshold. Low and middle income nations, by and large, consume well under the boundary. Okay. If we were all to consume like everyone in the rest of the world, we would not be facing a ecological crisis right now. If we were all to consume at the level of the average person in the average high income nation, then we would need roughly 4 planets to sustain that kind of resource extraction. Something similar is true when it comes to climate breakdown. I'll just be very brief about this. The vast majority of emissions in excess of the planetary boundary come from a small number of high-income nations in the global north. Here we see that rendered in quantified terms. The US is responsible for 40% of excess emissions. The global north as a group is responsible for 92%. The global south, the entire continents of Africa, Asia, and Latin America are responsible for only 8% of excess carbon emissions. And yet the south suffers 92% of the costs of climate breakdown in terms of economic impacts, and 98% of the deaths. So there's a real imbalance, right, between the causers of climate breakdown and those who suffer it. And I think we should think about this in kind of colonial terms, right? There's been this colonization of atmospheric commons with really devastating effects on those whose commons have been effectively colonized. Okay, now just to focus our attention on what's required here of our response to the climate crisis. In 2018, the IPCC published a special report on 1.5 degrees with this graph showing what's required in terms of emissions reductions to stay under 1.5 degrees, right? We know the headline. I mean, it means cutting emissions in half globally in the next 10 years and getting to zero by the middle of the century, right? Now, crucially, this is a global target. Under the Paris Agreement, there's a principle of common but differentiated responsibility, so that nations that have contributed more to the problem have to cut their emissions more quickly. So for high-income nations, according to scientists at the Stockholm Environment Institute, they have to get to zero by 2030, roughly, maybe 2035 at the very outside end. So, this really requires us to focus. We've built up a fossil fuel infrastructure over 250 years. We now have to dismantle it and replace it completely in the next 10, So the question becomes how, can we do this? And the answer is theoretically yes, obviously with a Green New Deal. So forget market mechanisms alone, that's not going to cut it. But with policy-oriented drives towards actively scaling down fossil fuels year on year, right, with a kind of declining cap, and also, a rapid rollout of renewable energy, this can be done. Now, here's the real clincher, though. The question is, can we do this while still growing the global economy? Now, 3% growth means nearly tripling the size of the global economy by 2050. So the question is better specified as, can we decarbonize the entire global economy by 2050, while at the same time tripling its size? Because the problem is that more growth requires more energy demands. More energy demands means it's much more difficult to supply the necessary renewable capacity to cover it. So you make your life much more difficult. And the answer to this is, according to all empirical studies, the answer is no, not even with the most optimistic possible policies, right? So what you have to do is you have to scale down total energy demand to make it easier for you to accomplish such a rapid transition. And this fact is reflected in the IPCC's reports. They point out that the only way to accomplish this transition without relying on speculative future negative emissions technologies is to actively scale down material production and consumption in rich nations, right? Now, why are they focusing on materials? Because the material economy is what drives energy demands, right? So the less material throughput you have in the economy, the less energy your economy requires, the faster you can accomplish the renewable transition, right? This is also coherent ecologically speaking, because you're not just addressing emissions, you're also addressing resource throughput, thereby reducing pressure on all other planetary boundaries as well. Okay. So again, the key lesson here is the less energy you use, the faster you can transition. So this is known as degrowth. Degrowth is a planned downscaling of resource and energy use designed to bring the economy back into balance with the living world in a safe, just, and equitable way. Okay, so it's a controlled downscaling. And the good news here is that degrowth can be accomplished while at the same time improving people's lives and advancing human progress. Okay, and this is where the scholarship on degrowth really comes into its own. The key principle here is that rich countries don't actually, I should mention, even while degrowth is focused on a reduction in materials and energy use, we expect that it's highly likely that this will be accompanied by a decline also in GDP, right? So we're not trying to degrow GDP, but the decline of GDP is an effect of degrowth principles, if that makes any sense. So the crucial point here is that rich countries don't need more GDP to accomplish their objectives. After a certain point, the relationship between GDP and social indicators completely breaks down. So you have countries like the US, for example, which have a GDP per capita of $60,000 US. Compare that to Portugal, which has a GDP per capita of 20,000 US dollars. Portugal has longer life expectancy, better social indicators across the board, right? So the US economy does worse despite an extraordinarily larger GDP. Over and over again, this is clear. Dozens of countries accomplish extraordinary outcomes with relatively little GDP. Okay. So the question is, how do we organize this kind of transition? The first step is to abandon GDP and change how we measure progress. GDP is a really clunky measure. It doesn't count the costs of economic expansion, right? And so we can use indicators like the genuine progress indicator, which do count the costs. Like this, it starts with GDP and then subtracts negative social and ecological consequences of growth. What we see is that if we measure the global economy by this metric, there's been a stagnation in progress since the 1980s, effectively. So switching your measurement basically gives politicians a different set of incentives to pursue. They seek to maximize social and ecological goods while minimizing ecological and social bads, right? And that's the kind of incentive we want politicians to have. But it's not enough just to switch how we measure progress, because in a capitalist economy, growth is going to continue happening behind the scenes, as it were. That's what capital requires. And so we have to have clear policies on actively scaling down material production and consumption, again, with the goal of scaling down not only resource use, but also energy use. So that can be everything from legislate extended warranties on products, banning the practice of planned obsolescence, introducing a right to repair. All of this makes goods last much, much longer than they normally do under existing conditions. And that means a lot less throughput, without compromising people's access to the goods they need to live. You can ban food waste. A huge amount of material is wasted through food waste. You can cut advertising expenditures, ideally to zero, effectively, as this removes some of the psychological pressures for excess consumption. You can shift from things like private transportation, which are materially intensive, to public transportation, which is a lot more materially efficient. But ultimately, we have to have a conversation on the importance of actively scaling down ecologically destructive and socially unnecessary industries, right? So instead of assuming that all industries should grow perpetually, exponentially all the time, which is an insane proposition, we should have a democratic conversation about which industries we still need to grow, say renewable energy, let's say public health investments, and which industries are big enough and should be actively scaled down, say industrial beef, say SUV production, private jets, whatever it might be. Okay. Ultimately, ecological economists are clear this is going to require a declining cap on annual resource use, which we can accomplish in a just way with something like a cap and dividend scheme. I won't go into what that might look like. Of course, as we use less materials, as industrial activity scales down, then there's less labor required in the economy. So in order to avoid an unemployment crisis, what you do is you shorten the working week, ensure that everyone has access to a job. You can use a public job guarantee to ensure that as well. This is advocated by modern monetary theorists quite persuasively. The problem is there's not a shortage of jobs. The problem is that jobs are not shared out fairly enough. So we can liberate people with more free time while at the same time scaling down excess industrial activity while maintaining living wages at the same time. This also requires effectively a shift of income from the rich to everybody else. The problem here is not really that we don't have enough GDP. The problem is that it's all captured at the top. The disparities are massive and insane right now. So it's crucial to recognize that we can achieve our social goals right now without any additional growth by simply sharing what we already have more fairly, rather than plundering the earth for more, right? So equality becomes a really essential antidote to the growth imperative. And this also requires us to expand public goods and commons so that people can access the goods they need to live well, such as robust universal public health care and education, affordable housing, et cetera, without needing ever rising incomes in order to do so, right? So you decommoditize key parts of the economy. And that takes a lot of pressure off of growth imperatives as well. The finance system was addressed a little bit in the previous presentation. Basically, debts are a huge driver of growth imperative. They come with exponential interest rates. That also requires growth in order to pay them down. So there's it's important that we shift to a public debt-free currency to take some of that pressure out of the economy as well. Again, modern monetary theory is very strong on this. But I want to conclude really briefly here with what degrowth means for finance. This is not my area of expertise. I will leave it to the other three panelists to really focus on this. But I want to offer just 3 really brief ideas. The first is the importance of democratizing finance wherever possible, whether that means bringing workers onto company boards, whether that means getting rid of the concentration of asset managements in terms of voting power, et cetera, et cetera. The more democratic our financial system is, the less pressure it has for growthism, right? People focus on more sustainable outcomes typically. Disaccumulation of accumulated capital is actually also really important. The more accumulation, the more overaccumulation you have in a system, the more it generates pressures for constant expansion. So that has to, I mean, you know, we can do this with things like wealth taxes, et cetera, et cetera. And then finally, a concept that is really integral to degrowth theory, which is called dépense. The idea here is that in every society, there's not a problem of scarcity typically. There's always a problem of surplus. And the question for societies becomes, what do you do with your surplus, right? And in capitalist societies, we reinvest surplus for the sake of constant expansion. But in a post-growth economy, we have to rethink what we do with surplus, basically. And the idea here is that you want to spend your surplus in a way that maximizes conviviality and well-being and ecological stability, rather than by reinvesting it for constant expansion. This is, in French, this is known as dépense. And we have the ethnographic record is full of of examples of societies that did this really effectively. Basically, whenever they had too much accumulation piling up, then they just got rid of it in a big feast that benefited everybody. And that's the kind of thing that we need here, whether that feast be a feast of renewable energy or a feast of public housing. I'm not sure, but the idea is you want to dispose of your surplus in socially meaningful ways. I explore a lot of this in this recent book that I just published a couple of weeks ago called Less is More, for those of you who are interested in taking the conversation a little bit further. Thanks very much.
Great. Great. Thank you very much, Jason. And thanks to the entire panel. We have about 20 minutes for some question and answers. We've got some really profound questions coming in. And just a reminder that this is not the only time that we will have to address these issues. John and Tiered in particular will be in breakouts, and the issues addressed by Natasha and Jason will also be addressed in breakouts by other colleagues. So making good use of our time, I would just start with a series of questions that were really kind of coming from Joe Brewer, Peter Jones, and Hank Hatters. And I'll just voice some of it directly. So Joe had said, and this is for Tiered, it is so important to create multi-capital portfolios that can be structured around bioregional economies. I am particularly curious about how to think about land as a bank on which to create these value flows. And Peter followed up on that by asking for frameworks that might be able to look at land and ecosystem valuation and conservation. And Hank seconded this idea of looking at bioregional shared impact measurement, reporting, and policies. So Tiered, I know that's a lot to address, but essentially, ways that ABN AMRO is taking its multi-capital accounting and applying it to land in particular in a bioregional basis.
Yeah, so what is interesting around these questions, and I'll try to answer them to the best of my ability, but what is interesting is that once you start on this impact journey, you're always pushing for better data, for better knowledge, for more accurate data on your impacts. And the reason for that is that enables you to steer towards less negative impact or more positive impact. So looking at it from a banking perspective and saying we have a 400 billion euro balance sheet and this is our impact, that's nice from a reporting perspective. But from an impact perspective, you want to know where is this money flowing to and what is the impact of that money on a regional on the land related topics, you can think of many slice and dice and much more granular detailed info that you would like. That is not the position that we are in at the moment. And from a top-down approach, so starting at this 400 billion, drawing it down to the client level and to the project financed or to the company that we financed level, that takes a long journey. So sometimes we start bottom up as well. Sometimes we assess the impact of a certain deal or of a certain client or of a certain project. And I think this is one of those questions that relates maybe more to that approach than to the impact approach from a corporate level.
Okay, great. Thank you, Tjeerd. And I should just mention before moving on to the next question, that one of the participants, Laura Ortiz, noted that ABN AMRO appeared last week in a deforestation report from our Rainforest Action Network about financing in Indonesia. I just would put it out to you, it may be too much to discuss, but if you could quickly comment on that, Tjeerd.
Well, quickly comment on that. It's a longer debate than time allows probably here, but we try to engage our clients. So we have very strict policies on deforestation, and we engage with the clients that do not adhere to these policies. So if that is the case, then or whenever that is the case, then we engage into a conversation with our clients and try to stimulate them or force them into improving the situation. I think that's the best answer for now.
Okay, great. And a reminder that we can go into more depth. We encourage folks to continue asking questions. We are saving the chat function, and we will also take questions at hello@r3-0.org that can be answered in follow-up. But this does lead to another question for Natasha. And this is coming, I believe, from Dominic Burke, as well as Tariq, that was pointing to essentially you're talking about using the system to change the system. And I guess to use some of the language that John was referring to, are there limits to engagement? Are there limits to the degree to which engagement by shareholders can actually change the system, given that that's participating in the system, if you will? So Natasha, over to you.
The answer is yes. I mean, I think that's really, if you look at the case studies that I showed, it was all about butting up against resistance. And, I think at a large level, it's sort of a 30,000 foot view. We have the existing capitalist system that is humming along with public markets and sort of business as usual. And, and there's things you can do to make that a better system that has huge, ripple effects and impacts, right? And so we're engaging in that work. And then on the other side of the coin, you've got private markets and sort of private market impact investing, and innovation, where you're really those small businesses, right, that you're growing, and where you're really creating the new economy, a more sustainable paradigm, or at least where that is an option in a different kind of a way. And I see them kind of both moving in parallel, right? You don't want to fully ignore the existing system and just continue to have that oil tanker headed, to the iceberg, but you also want to engage it. And then the other system, at some point, there's got to be a convergence where the best ideas over here infiltrate, shift, change. And that's certainly my hope in terms of what's going to happen at a high level. I think, it's not just the system, though, where you're facing resistance in terms of what I was talking about around engagement with Exxon, right? You had the Securities and Exchange Commission as a roadblock, which is a political organization. You have large institutional investors where there is low risk tolerance for doing anything new and changing things, right? The people in those jobs, those are hard jobs to get. It's kind of like that old adage, you never got fired for buying IBM, right? They're not going to change their ways. And then you have, like, I think about us as, a boutique wealth management firm, right? We're independent, we have flexibility, we can sort of push in ways that that others can't. We can take a little bit more like maverick risk, whereas there's a huge aversion to risk in large institutions. And so, if we can't shift within the existing system, the kind of the political roadblocks, that large institutional risk roadblock, you really have to give permission for that to shift, because it can't be all one or another. That's not going to work. There has to be some kind of a convergence.
Well, Natasha, you're definitely using language that rings in our ears. We worked with Raj Thamaratham from our partner, the Preventable Surprises, around the whole definition of positive maverick. And we believe ourselves and our community to be folks who are working within existing systems, but in maverick ways that seek to transform those systems. So thank you for that response. John, over to you for a question from our advocation partner, Jesse Henshaw. And in some ways, this is really pointing towards the last issue that you presented, the Capital Asset Review Board, or Capital Investment Review Board. So John, how would you describe the movement to foregoing investment growth and actually spending capital assets to relieve our many global crises? Is anyone organizing that, or is this really the CIRB that is coming into play here?
Well, that idea is very consistent with, it's interesting. Jason, I don't use the language degrowth because I find it's a kind of a conversation stopper. But as you described it, I couldn't agree more. We need to, because anytime capital is invested, it has a footprint. And so, the capitalist system for 500 years has managed to accumulate unimaginable stocks of financial capital. And whether it stays invested in an existing business, it creates ecological footprint. And one way to think about it is the scale of capital is too big. It's not really population, as Jason pointed out, it's population behavior in the rich countries. Another way to talk about the same problem is that there's too much capital in rich countries, and capital has this automatic, thing that causes it to demand more footprint, unless it's very carefully targeted. And you can describe it as spending it away, having a party and having eating a feast. The language we have for that in our modern society is philanthropy. And that's why I think that we need to reinvent philanthropy and think of it as a systemic rebalancing of this imbalance. And it shouldn't be viewed as, oh, I have to give my money away. It should be, wow, I've been successful in my tech startup and now I'm a billionaire. And how can I quickly recycle that capital, not into becoming a 100 billionaire, but into regenerating the ecological capital and the social capital that is causing society to disintegrate. So yes, it's very much a conversation that I don't think has even started yet. And by the way, just the stranded asset issue of swapping out of the fossil energy system will demand a reinvestment in society. Think of any fossil-led economy nation and the amount of investment needed to transition that economy, not just to transition off fossil fuels, but Venezuela's entire economy is predicated on spending petrodollars. And look what's happened to Venezuela while they're still allowed to burn or to produce their oil. So we have such massive investment needs to stabilize society and stabilize the ecological systems that underlie our society, that we simply need to recycle that surplus capital in a very thoughtful, intelligent way, and we need to do it in decades, not in centuries.
Okay, great. Thank you, John. And this actually leads to I'll bundle some questions for Jason. One of them, actually, I'll name, and you can chime in on it, but please know that Janez Potocnik will be leading our next session around this. So Martina Prox, one of our advocation partners, was wondering about the European Green Deal in terms of its impact. And that's really in some ways kind of bundled with a couple of questions from Peter Jones around MMT, modern monetary theory, and particularly, he was interested in hearing more precautions for MMT. If state capital is theoretically unlimited, this would create policy-driven growth. So the question of, if we can, if there is no limit to state debt or deficits, if you will, what are the implications of that? And then finally, Jesse had talked about this question of financial growth as well. So Jason, over to you for that kind of bundle of questions, if it's not too much to handle.
Yeah, no, thanks. No, the MMT question is interesting. So MMT scholars, okay, I should first say the proposals that I made in my presentation do not rely on MMT. We can think about MMT as offering us new kinds of opportunities, but let me briefly say this, is that MMT does recognize limits to the creation of money. The limit is inflation, and the limit is ecological. Okay, so we have to pay attention to those two limits. Now, I think that there's actually a lot of room for degrowth to take this proposition up and think about it this way. So effectively right now we have an economic system organized around exchange value, primarily, right? Organized around profit making, in other words. Whether or not it actually delivers use value to people, right? What we want to do is we want to switch to an economy that's based primarily around use value, with exchange value a kind of sideshow. Now, one way to think about that is you use MMT to publicly fund, social goods, okay? Healthcare, education, housing, whatever it might be that you have to do in order to ensure that people have access to the goods they need to live flourishing lives. And then what you use is taxation in order to pull demand back out of the economy from the top, reducing inequality and reducing demand for the purposes of remaining within ecological limits, right? So the MMT is used to fund use value, and then you pull demand out of exchange value by using taxation, progressive taxation. I think that's the way that we can think about it. I'll be writing about this shortly on my blog, I think, because it's something I want to explore more. Really briefly on the question of degrowth, yeah, I think it's a powerful word, and the reason I think it's powerful is because growth is the ideology of capitalism. It's the ideology in the Gramscian sense, right? That it gets everyone to buy into a process that ultimately benefits a rather small faction of our society. Okay, so growth is primarily organized around elite accumulation on the one hand, and appropriation from nature and labor on the other, right? And these two are two sides of the same coin. The idea of growth is the alibi of this process. It's saying we're going to do this destructive stuff and accumulate for elite purposes, but we're going to have growth at the same time, so all of you will benefit from it somehow, even if just a piddly amount, right? So we have to challenge that discourse and break that ideological hegemony. And I think the word degrowth does that really effectively. It forces us to recognize that there's something else going on in the economy, namely that what's growing is not necessarily good stuff. What's growing is ultimately material and energy throughput. And on a delicately balanced planet, that can't go on, right? And so it poses a direct challenge to that conundrum. When we think of growth in sort of immaterial things, GDP, right? But in reality, what's going on is growth in material and energy impacts, right? So when we talk about degrowth, what we're doing is we're clarifying what growth is actually about. Okay, growth is actually about materials and energy. Degrowth is about materials and energy, and that's what we need to focus our minds on, right? So I find it very clarifying for people, actually. But of course, requires a conversation.
Yeah, it's a very interesting framing. It's similar to how we at R3.0 first articulated our strategy continuum, which we now call our maturation matrix. And instead of having it go up and to the right, as every graph that we've ever seen, the desire is to move that, we consciously had it go down in the other direction. And it was interesting how many people said, well, you're not going to get any buy-in if you do that. We're like, we know. we're actually, that's a conscious choice on our part. So there are linguistic and sort of mimetic framings here at question. We are at time, so I want to thank the panel deeply for your participation. A shout out to participants to take this conversation even more deep in the breakout sessions. Tiered will be speaking with Geeta Iyer from Boston Common Asset Management. That's a slight change from the program. John Fullerton will be speaking with Laura Ortiz with Stuart Cowan facilitating that. And there will also be a session on degrowth with Susan Paulson and others on that panel. So looking forward to folks tuning in. I do know that there was plenty of conversation in the chat, including a question around focusing on anthropocentrism and the Maori donut. That also will be in subsequent sessions. The Maori donut in particular, Taina Bosadine will be presenting on that. So lots to stay tuned with. Thank you to our speakers. And we will be heading into a break now. Our standard process, I hope that some of you were able to enjoy the break, the mindful movement that starts things out. So we will move again to Jennifer Diana Nucci, who will lead us through an optional 10 to 15 minute mindful movement session. This is not something that is vigorous. You can do it seated if you wish. And that opens up our 1 hour break. So we will be reconvening here. Please tune back in a little bit before the hour where we will get things rolling on the value and circularity session. So Jennifer, over to you for some mindful movements. Thank you.